Good morning! Here's a direct, step-by-step guide to a protective put, married put style approach for crypto in the USA, plus how to think about minimum profit. I'll also give you a sample calculation. Important note up front. In the USA, there isn't a simple, retail-friendly, spot crypto protective put product on a national exchange yet. The closest regulated path is to hedge with options on futures, for example, Bitcoin futures options on CME, or to hold the crypto and use available US-listed derivatives on related products. This guide describes the concept, how you'd implement it in practice given US regulation, and the math behind minimum profit you can realistically expect. Always verify current market availability with your broker and consider tax, liquidity, and margin requirements. Step by step, protective put, married put style for crypto in the USA. 1. Define the goal and the notional. Objective: downside protection for a crypto holding, e.g., Bitcoin. Notional you want to protect. Decide how many BTC you hold or plan to hold, e.g., 1 BTC, 5 BTC, etc. Time horizon: choose an expiration that matches your planned protection period, e.g., 1 to 3 months or longer if available via CME options. 2. Understand the US regulated route. What's realistically available? Direct spot BTC. Put: not typically available as a retail listed option in the US. Common regulated hedge: long BTC, spot, or futures position, plus a put on a futures contract, e.g., Bitcoin futures options on CME, or other US regulated derivatives that give you a similar downside protection. If you can access CME Bitcoin futures options via your futures/broker account, that is the closest regulated analog to a married put for crypto. If CME routes aren't accessible, you may need to simulate hedging using other regulated derivatives, or accept the unhedged risk, or look at options on crypto-related products that your broker supports. 3. Choose the actual instruments in practice. Underlying exposure: own BTC, spot, or a BTC futures position that you want to hedge. Protective hedge: a put option on a BTC-related futures contract, e.g., OND. A Bitcoin futures put with a chosen strike and expiration. If you hold futures, you'll often hedge with a put on the same or a closely related futures contract. Important notes: there's a basis risk between spot BTC and futures, and the pricing/availability of options can vary by broker. Work with a broker that supports futures options on the asset you're using as the base. 4. Decide strike, K, and expiration, T. Strike, K: the price at which you have the right to sell via the put. A higher K provides more downside protection but costs more premium. Expiration, T: choose a horizon that matches your risk tolerance and plan. Longer dated options cost more but provide protection for a longer period. Practical rule of thumb: pick a K that reflects the price level where you'd be uncomfortable if the price fell to, and pick an expiration that covers your expected risk window. 5. Estimate the option premium, P. Get live quotes from your broker for the put option you're considering. Strike K, expiration T on the appropriate futures contract if using futures options. Premium is what you pay upfront for protection. It's sunk cost if you don't exercise. 6. Size the position. Position size for protection. Usually you scale the put to cover your crypto amount. For example, one put contract might cover a notional amount equal to 1 BTC or 5 BTC, depending on contract specifications. Ensure your total position, crypto plus put premium, stays within your risk budget and margin capacity. 7. Place the trade, entry. Step 7A. Buy the crypto you intend to protect, e.g., buy or confirm you hold 1 BTC or your target BTC exposure. Step 7B. Buy the put option on the corresponding futures contract, strike K, expiry T, or on the instrument your broker supports for hedging. Step 7C. Verify the combined position shows as intended. Long asset plus long put. 8. Monitor and manage delta and theta. As time passes, the put's value decays, time decay, and the hedge may drift. If BTC moves strongly, you may want to adjust, roll the put, change strike, or adjust exposure. Rolling. Near expiration, roll the put to a new strike/expiration if you want to maintain protection. This often involves closing the old put and opening a new, longer-dated or closer-dated one. Liquidity and gaps. Crypto markets run 24/7, and futures options liquidity varies by contract. Expect weekend gaps and liquidity thinness at times. Rebalancing. Periodically rebalance your hedge to keep the protection aligned with your current exposure. 9. Exit or roll to another hedge if risk changes. If BTC rises substantially, you may reduce or terminate the hedge and take profits on the put premium, or roll to a higher strike to maintain protection at a different price level. If BTC declines or vol increases, you may want to strengthen or adjust protection. Different strike, later expiry. 10. Tax and costs. Premiums are generally considered a capital investment or a cost basis for hedges, depending on your jurisdiction and broker. Crypto tax rules vary. Consult a tax advisor. Consider commissions, bid-ask spreads, and any margin costs on futures/options accounts. 11. Minimum profit reality, what you can and cannot guarantee. A married put provides downside protection, but not a guaranteed profit. Your outcomes depend on BTC's price movement, the cost of the put, and the chosen strike. Payoff at expiration, conceptual for 1 unit of BTC. If the price at expiration ST ut KK, you stay above the strike. Payoff ETQ ST S0 P. If ST K price falls below strike, payoff EK S0 B here. S0 E price when you enter the position, your initial BTC price or current market price for the baseline exposure. BPE's premium paid for the put. KE put strike. Bottom line for minimum profit, the worst case payoff across all ST is K. S0 P, the floor you've set with the chosen strike. If you want a non-negative floor, you'd need K Solshi S0 plus P. You still pay the premium P up front, and if BTC drops below your strike, the floor limits how much you can lose relative to the initial exposure. But it may still be negative if K is not high enough. Example, numbers for illustration only. S0 equals $30,000, K equals $32, P equals $2,000. If STP $32, payoff equals ST $30,000, $2,000 EST $32,000, break even at $32,000. If STT $32,000 cease, payoff yield $32,000 C, $30,000, $2,000 E0 floor. So the minimum payoff in this setup is 0 if STT E $32,000 T. Above $32,000, you can gain as price rises. If you want a guaranteed non-negative outcome, regardless of how low BTC goes, you'd need KD as 0 plus P, which makes the put significantly more expensive upfront. 12. Quick safety checks. Confirm regulatory access with your broker before placing trades. Confirm contract specs, cover, size, expiry, and margin requirements for futures options. Be mindful of 24/7 price action and weekend liquidity for crypto and derivatives. Consider risk management. Don't overallocate to hedges, maintain diversification, and know your total exposure. Sample calculation, simplified. Setup. You hold 1 BTC at S0 equals $30,000. You buy a put with strike, K equals $32,000. Premium P equals $2,000, expiring in 2 months. Outcomes: if BTC ends above $32,000, payoff equals SRT, 30,000, 2,000, soon ESLT, 32,000. Break even at ST or 32,000 rounds. Gains above that. If BTCN ends at 31,000 tours, payoff on 32,000 mers, 30,000 sound, 2,000 sound E0, you break even. If BTC ends at 28,000 yuans, payoff equal 32,000 rounds, 30,000 shared, 2,000 E0, still break even because the floor is set by the strike. Note, this simplified example assumes perfect hedge alignment. Real results depend on exact instrument and execution. This illustrates how the floor minimum payoff is determined by K, 收益, S0, P, and how the break-even point depends on S0 plus P. Please like, subscribe, and comment.